All right, Jolie, welcome back for, I think this is episode 18 of Money in the Tank. We've had a bit of disruption, but yeah, how you going, mate?
Good afternoon, Dog. We've got through our technical difficulties of me trying to work out my microphone for the past 5 minutes, and then Arnie saying, "Oh, sorry, that's my bad. I had the wrong speaker on." So, anyway, the joys of technology.
Yeah, I am technologically inept at the best of times. It's a miracle we can even get a podcast up and running.
Mate, we've done well. It usually is my fault. So when I found out it was you not putting the speaker on, I thought, oh, that's great. So anyway, no, mate, welcome back. It's great to be back. And after our hiatus last week into financial year, got super busy at work, and so we had to take a bit of a breather. But yeah, thanks for tuning in, everyone. My name's Joel Seach, Principal Advisor of Harpel Financial Group, and then you got Arnie, tax professional.
Yeah, you got me, mate. That's it. And we did, like this week, Joel and I thought we'd just do a bit of an update on some interesting things that are happening in the Aussie market at home, some interesting things that are happening a bit broader. And then we're going to touch on a question, which is you sort of see come up in social media a lot, is if you had $1,000 to invest today, what would you invest it in? And then we've got some good 50-50 in Q&A. So if you guys want to give us a like or a subscribe or a comment on the YouTube channel, it's at Money in the Tank. You can find us at Money in the Tank on Facebook, Instagram, Twitter as well. And we'll do our best to be more active there, because it's sort of that's something we've got to get better at, Jolie. But yeah.
Yeah, absolutely. And feel free to leave questions that you may have in the comments section, or flick us an email or on social media. And we'll also have a special guest coming on next week in the podcast, so stay tuned for that at the end of the program today. But firstly, without further ado,
yes,
Australia's top-selling investment book, 1999, Rifkin's Rules. Here we are. Here, let's have a bit of a peek. So, Renee's favourite Rifkinisms. We've got two. So, my first commandment is, you can do whatever you want as long as you don't hurt other people. Strange. Thankfully, I'm just a big kid after all. So there you go. Two interesting ones there. Given that I don't know his history with that sort of thing, but Rifkinisms.
I like that first one. Yeah. Like it's sort of like do whatever you want, but do no harm.
Do no harm.
Good one, Rifkin.
Exactly. I've marked them down, and then three for one today. If you don't like it here, leave. Strange, but anyway.
Oh, gee, that's getting a bit. Bloody hell, Rifkin.
Rifkin, mate. Yeah, odd.
Brutal.
So they're getting stranger and stranger. But no. So on the topics of current news items, Arnie. So a few things to write home about from the last week. Things in terms of the markets, both domestically here and property here, but also overseas as well, specifically the Dow. And then the RBA, which is the Reserve Bank of Australia, for those who don't know, met on the first Tuesday of every month. They've just come out with their latest RBA cash rate decision.
Yeah, so they've again said they're going to hold it at the record low rate of 0.1%. And there were some interesting comments made by the governor, which is Philip Lowe, saying that he thinks that inflation outcomes in Australia are further away from the target that the RBA wants to achieve. And it's partly linked to wages, is what they were saying. So they were basically saying that even though the real economy here in Australia has been doing well, almost better than any other Western country throughout COVID pandemic, the outcomes of our wages situation and inflation have not been better. And we're further away than we should be on those key variables or metrics, I guess you want to call them, in the economy. So
he said in his notes that it's not enough for the inflation rate to be forecast to be in the range. We want to see results. So they want to see the data actually trend over time. And then also you reiterated about that wage growth, which you mentioned, Arnie, is he wants wage growth to hit around 3% for its inflation target to be met as well. So the focus on wages doesn't mean we have a target on wage growth, but he wants to sort of see that band working. And he says, to re-emphasise the point, that the condition for an increase in the cash rate depends on the data, not the date. So people in the media love to push that 2024 and 2023 type thing. It's purely based, he says, on inflation outcomes, not the calendar. So he wants to see that. And he says the central scenario remains that the condition for a lift in interest rates will not be met at this stage from the data they're seeing until 2024.
Yeah, that's what they're saying. They're saying in their model in 2024 at the midpoint sort of scenario. So not the best case, not the worst case. But I guess it's sort of interesting to hear those comments from the governor. And I know that the financial news media will be pushing for a date because, in the stock market and any other sort of asset class market, people love certainty. But he's right, it should be data driven. And I know even before the pandemic hit, we had a bit of a wage stagnation problem in Australia with a lot of industries sort of wages failing to keep up with inflation in other parts of the economy. So I think personally, it's encouraging to hear the RBA come out and say that. Another bit of interesting news that came out of what they said was that they're going to be pulling back on the stimulus from $5 billion a week in bond purchases to $4 billion a week in bond purchases, and that's going to continue until November, and then they're going to review it again at that point in time.
Yeah, so what that means for the listeners out there is the government over the period of time, the RBA, has been buying bonds, not specifically directly from the government, but almost in a secondary market. So the government releases these bonds, which is essentially an IOU. So they say we need, let's say $100 million. We'll issue the bond to the market to tender, and then the RBA effectively is buying those bonds, putting the money into the government's pockets to be able to spend on stimulus, and the government will pay back that money at a period of time with an interest rate in there. So the RBA has been pushing out that $5 billion. It's now down to $4 billion. So they're just easing that. What's it called? I think it's called the TFF. So
yeah, that's right. And they're doing that because they want to support. They want to support monetary conditions to support a return to full employment. So if they're putting this stimulus into the market, and the market should be using it for growth, and that's sort of what the point of it is, right, Jolie?
Yes, it's helping to stimulate growth and put liquid money into the market to allow that stimulus for the banks to be able to lend, and for the government to be able to fiscally put money into the economy where they see they need it to be done, whether it be through infrastructure or your JobKeeper sort of stuff, which is now stopped. All those sorts of things is where the fiscal stimulus comes into the market, so that the government gets that money, borrows it at very, very low interest rates, should be mentioned. So the interest rates have really worked in their favour in that regard, so they don't have to borrow at higher costs, and they pump that money into the economy to then hopefully help stimulate all these industries and help create that employment. And employment is doing quite well, I believe. It's just that wage inflation. And then the board or the government, the RBA wants to see that a band of inflation between 2% and 3%, which is they want to see that sustainably consistent between that range before they consider raising rates. So they want to see that they're not just a transitory change, which is sort of what we're seeing at the moment, where we're having a lot of peaks of different costs of inputs, which we've spoken about before on the pod. Yeah.
I must apologise to the tankers too. My neighbour's dog is barking, and I've got my dog on my lap. So if you hear any little growls, it's my dog. I'm trying to keep her quiet. But just going on to that topic, Jolie, I guess the next sort of logical point is we're seeing really huge growth in the property market in all regions across Australia, capitals and regional. And also in the share market, but we'll touch on the property market first, because that's sort of like a result of all this money sort of slushing around in the system, right? Like there's more money to be deployed. Where's it going? It's going to assets. So do you want to talk about this first? Or I've got a few little interesting data points about the property market I can quote here.
You fire away with your data points, mate, and then I can slide in with anything extra.
So there's a CoreLogic home price index, and in June alone, house prices were up 3% in Hobart, 2.6% in Sydney, up 1.9% overall. It's up 13.5% over the past financial year, with Darwin 21%, Hobart 19.6%, Canberra 18.1%, and regional markets 17.7%. So this is the strongest annual growth rate in house prices Australia has seen since 2004.
Yeah, huge. And I think we mentioned it before on the podcast that property markets don't tend to move together like they have done. So it's really unusual as well for every state to pretty much and city to be and region to be going in a positive territory or positive direction at the same time. So, unusual circumstances, because, usually it might be, let's say Tassie, for example, moves quite a bit, but Perth goes backwards slightly just due to different economies and different factors.
Yeah, and interestingly, I was having a look at the median house price across the country. One of the cheapest, not the cheapest, but I guess like on the cheaper side is Darwin. The median house price in Darwin is 567,000, but the rental yield in Darwin is the highest, 6.1%. So a bit of interesting information there. So I mean,
Could be skewed a bit. Could be skewed a bit from workers, fly in, fly out, or people, staying on short-term accommodation where there's a high rental demand.
Yeah.
But one of the things that I've noticed, I think, recently reading about the rental demand, and this is a concern, I think, or should be a concern on the government, is, if the government potentially has disincentivized to an extent investors, buying an investment property, and let's say it's just a mum and dad investor. They've just taken a few incentives away and made it a little bit more difficult from regulation and whatnot to do that. And now you're actually finding in some of these regions and these places that have had a bit of a surge in property, there might be a lot of first home buyers or people buying in there, but you're actually finding real tight rental squeeze now. So people that might be emergency services workers or workers that are trying to get into a region to work, they may not permanently want to be there in the end. They're really struggling or they're never going to be in a position maybe to purchase. They're really struggling on a rental side of things because that demand supply factor we've talked about before is that supply factor is really shrinking. So the demand is quite high. So it's pushing those rental prices up. So the government's got probably some more to play out there in terms of this issue. I think there's going to be more to come and that undersupply of rental properties because of that sort of that kind of roadblock around having investors be I guess incentivized to get into the market to provide these rental properties.
There was actually an interesting data point I read during the week that said, like, during the pandemic, it was the first time since 2007 where house purchases, or I guess purchases of dwellings, not just houses, like could be units and stuff as well. It actually flipped where there was a majority of new home buyers entering the market as opposed to investors. But it was very short-lived, and now it's sort of the trend, which is we've seen for years and years and years in Australia, is going back the other way, where there's more investors getting into the market to buy more investment properties and less first home buyers. So, yeah, interesting stuff.
I think this recent one's been a lot more first home buyers. And I think even if you look at the stats, the vast majority of people that own an investment property is just that. It's one property. They're mum and dad investors, and they're just potentially trying to help, prepare themselves for the future and maybe prepare to be able to not have to live off too much of the age pension or have an asset there in the end. So I think the stats are quite interesting in that regard. But I think the latest run's been a lot of first home buyers or home upgraders, home upsizers, or downsizers too.
Yeah, and then you want to move on to the share market, or do you want to talk more about the property?
Yeah, so I think, property we sort of, spoke more broadly of then. I don't have too much to add at the moment, apart from that, it's been spurred along by low interest rates, some incentives, some government incentives, both federally and state. Clearance rates are still, I think they were about 80% in Victoria last week, and I think they're still fairly strong.
That's real strong.
Yeah, well, they've been up in the high 80s, I think, and 90s for the past few months.
Wow.
So, it's been, I think usually like an average is around sort of 60 to 70%, maybe 70 sort of average. But anything above that 60 to 70, I think you're starting to get quite a lot of turnover. So there's still supply factor and lessened supply and higher demand. So I think there's still a bit more to play out. Eventually, as we've said, it can't keep going forever. It'll eventually plateau, but it's just what time that'll plateau and how long it'll take. It's anyone's guess.
Yeah, I know. It's sort of in the back of my mind. And again, general in nature, not financial advice, but I'm thinking about, should I fix a part of my mortgage before all this stuff sort of hits? But anyway, let's move on to the stock market. What do you reckon, Jolie?
Yeah, for sure, mate. So, I guess the overview of the stocks, so the US stocks, rose to record highs last night on the back of some of the Federal Reserve's latest meetings, sort of mentioning about they're sort of debating over the tapering of their debt purchases. So similar to the QE, quantitative easing that we're doing, in Australia. It's a different version of it. So they've sort of debated that. So I think the market's reacted to that and I guess, hit record highs because of that. So the S&P Standard & Poor's 500, which advanced to, I think, an all-time high of 4,358, and the The Dow Jones rose 100 points, and then the tech NASDAQ, which is the tech. So if anyone sees the news and sees the NASDAQ, that's all the tech heavy stocks in America. That was flat, but that had a really big run the past month. I think the big tech favorites, so Apple and Amazon, over the past month, I believe it was about 15% they were up. So quite interesting.
I think the NASDAQ, even though it finished flat, intraday it hit an all-time high as well. So pretty crazy.
Yeah.
But you're spot on, Jolie. And the Fed in America, you're right. The June minutes from their meeting were released, and I guess investors were happy to see that there was not a majority of support to have tapering occur sooner rather than later. And I think their timeframes are similar to Australia's, where they're talking about, we're tapering immediately a small amount, but they're talking about not doing it for a couple of years because they want to make sure that the economic conditions are sound and they're out of this crisis, that COVID has caused. Other interesting news was that the Treasury yields, the 10-year in America, dipped to about 1.3%, which is encouraging for growth stocks over in America. And oil dropped yesterday because there was it hit a high during the week off the back of OPEC talks, but then OPEC failed to come to a deal to increase the crude output. So there's a bit of interesting space in the oil market at the moment. So I don't know, that's what's happening.
And the Australian market is tracking along. It's sort of, I think that the Australian market's following what the Dow Jones does overnight, and tends to be following that direction too. So they're high. I think they're almost at all-time highs. The All Ords about 7,600, and the ASX is closed about 7,300. So if they're not all-time highs, I think they're very close to.
Yeah, there was a big news from the stock market yesterday, ASX, where Challenger Limited was up 8.8% because a international company, I think it's called Athene, bought 15%, a minority interest stake in it. So that's an interesting one as well to watch what's going on in that space. And they deal with financial services for retirees and things like that. So, and I think they operate
some Challenger ads,
Yeah, they operate in Australia, America, UK, other places. Challenger's
a big one.
Yeah. Other Aussie news, as of 1 July, superannuation increased 10%. But there was some interesting news saying that some employers were cutting the base pay from people to fund this. In particular, Telstra and ANZ have said they're going to do it, but only for executives. So they're going to cut the executives' pay by 0.5% to fund the 0.5% increase in super. What do you reckon about that?
Yeah, a bit dodgy. A bit dodgy. Like, in financial advising world, you sometimes come across, I think back in the day it happened a bit more. I think it's actually been outlawed now, but companies, if you used to salary sacrifice some money, let's say leading into retirement, let's say you're on a wage of 60,000 and you wanted to try to pump some money into super before retirement. So if you're on 60 grand and you put, let's say, $10,000 in, instead of getting the 9.5% of superannuation paid on your $60,000 salary, that actually paid on your $50,000 salary. So they do a bit of a dodgy in terms of, instead of them paying you $5,700 of super guarantee, they'd actually only pay you $4,750. So they'd actually do a bit of a sketch. Some companies did that. No, it sort of reminds me of, I think that's been outlawed now, but it sort of reminds me of that. They're sort of saying, well, your total package might be $110,000. Well, we're going to sort of just adjust we're just going to adjust the super portion of that, and we're going to pay you, the $10,000 of super, and your base wage essentially is going to be now $100,000. So just to give nice even round figures. So that's how they sort of, they've manipulated a little bit, rather than saying, we'll pay your base wages, is $100,000. We're just going to pay you the extra on top of that.
Yeah, it's not in the spirit of it, right? Like the whole reason that they're trying to increase the super contribution guarantees so that people have got a better retirement. And these guys are just saying, well, we're going to rob Peter to pay Paul. We're going to take it off you now, but you still get the benefit of super. So I don't know. It's mixed news. I wonder how it will be received.
Yeah, I think there's a lot of companies that have done the right thing by it, and they've just given the people, given the employees, given the people what they want, the extra 0.5% of super, which they'd be eligible for. So, to those companies that have done the right thing, I think good on you.
Yeah, it's good. And there's some other little tidbits of news. So there's a tax reprieve for small to medium business owners where the corporate tax rate for businesses earning less than 50 million annually will be 25%. So that's been coming down over the past couple of years, and I think that's where it's slated to finish. Do you have any other bits of news, interesting news, Jolly, that you want to touch on?
I reckon they're the main ones, Arnie. I think they're the main ones. I remember reading something around, but I'll probably have to bring it up next week, is around, it was yesterday, maybe it was China banning something. Again.
Didi. Didi.
Yeah, so Didi, the rideshare company, if anyone in Australia has used Didi, I've used Didi quite a few times. They tend to be about sort of 20% cheaper than the other ride shares because they don't take as much of a cut. So the drivers get more of a share. DD takes less of a cut. So if people want the app, I don't have any shares in DD, so I'm not promoting it by any way, but it's a pretty good tool to use.
I've used DD.
They're good. So China, they banned the use until they could confirm their tech was secure enough, wasn't it? They banned it.
Yeah, so it's interesting timing because I think Didi just listed on one of the New York exchanges, and now the governance has sort of been called into question because they've said, did they know about this? How far in advance did Didi know that China wanted to pull Didi from app stores in China only, I should say, but still like a big chunk of their revenue, that's where they're from. And as a result, I think it was down like 19% at the end of the day yesterday, Didi shares. So pretty big news, yeah.
Yeah, well, China, has got a lot of money there, and they're a huge market, so they've got the ability to push stocks and even push crypto as an example. I think they've still banned Bitcoin use, have they? And then you've got your smaller countries, which there's a country that's actually is happy to use it because they've got a bit of a sketchy economy. It's one of the I think it's one of the South American countries. I forget the name of it.
Argentina, maybe, or something like that, or
something like that. I'll have to get back to you. I'll remember the name, but they've actually promoted the use of it because their currency is a bit kind of patchy, and they've got a lot of issues with drugs and whatnot over there. And it's quite interesting. One economy's banned it, one wants to use it.
Yeah, I really want to get a crypto expert on because I've heard interesting things, especially in markets like Germany, where the government is promoting it through banks and things like that everyone should buy a bit of crypto. Not heaps, but they're just encouraging the population to have a small portion of their wealth in it just in case it goes ballistic, which is an interesting perspective from a government. But one other thing we want to talk about...
El Salvador.
Okay.
Yeah, so we'll soon consider Bitcoin legal tender, as some politicians in Central and South America want their country to be next. So we'll see where that goes. We'll keep an eye on it. So they're supporting Bitcoin potentially, the legalization of it. So
that's huge news. That's huge. That feels huge. I don't know enough about it, but one other little fun thing we wanted to do today was, given the fact that stock market all-time highs, property market going crazy, we thought it might be fun just for you and me to speculate, Jolly, about what we might do if we wanted to invest $1,000 today. So for educational purposes only, general in nature, not financial advice, but we sort of wanted to touch on, if we had $1,000 in our hot little hand, where would we put it right now?
There you go. So, Arnie's got a couple of specky stocks he's going to throw. He's going to throw at you. Couple of little stocks to keep an eye on. General in nature as always. We don't provide advice, but one of the stocks that I've been following is what's it called again? I'll just have to get the name of it.
Is it PointsBet?
BetMakers. BetMakers. So BET. So look at that code, BetMakers. That's a sort of a dollar stock, and they've started to have some negotiations with Tabcorp, and they're doing some streaming of British and Irish horse racing in Australia. So they've got some scope there, and they've creating some deals there as well. So they're sitting at about $1.15 at the moment. They were up yesterday, down today. So that's just a small stock for people to keep an eye on. General in nature as always, just keeping an eye on it. Arnie, you had a couple of stocks to keep an eye on, and then I can give a bit of a broad one.
Yeah. So if I had $1,000 to invest today, as it's probably no secret because I've released a couple of videos on it, but the number one thing I'd want to invest in would be Psth, or Pershing Square Tontine Holdings, and the other one would be Ford. And I might just give a real high-level overview of why I like these stocks. It's basically, I'll start with Ford because Ford's an established company where Psth is more of not an unknown, but it's a SPAC. It's a unique structure. So Ford, I feel like it's just got incredible brand recognition. They've got incredible product lineup being released globally, and they've had in 2020 they had a bit of a shake-up, change to their management, and the new CEO is sort of a long-time Ford man and inspires a lot of confidence. But if you look at the metrics or you look at the fundamentals of Ford, I think they're overvalued compared to their peers in the market. Sorry, I think they're undervalued compared to their peers in the market. So I'm talking about GM and Tesla and other players. But they've got good, solid revenues. They've got minimal amount of debt in the automotive business. They've got higher debt in the credit business, but it's sort of being used as a mechanism to sell cars. I don't think it's not bad. It's not a bad cup of debt. And basically, I just feel like there's a bit of growth to happen in that segment. One thing you need to be careful of when you're looking at automakers is that it's a cyclical type of business. So they'll go through these sort of boom and bust cycles. And I think a lot of autos are squarely placed in the boom cycle at the moment. So I hold Ford shares and I'm expecting them to go higher. PSTH is another one which I really love at the moment because there's been a deal announced where they're splitting it into 3 different securities. So it's currently trading at about $22 a share. And sometime later this year, it's going to split into shares of UMG, shares of RemainCo, and shares of a Spark, which is a special purpose acquisition rights company. And what you're going to get for your money is shares of UMG, shares in an undisclosed company, which I think they've actually got a target already for the RemainCo. And then this Spark, which is a right to buy into any future deal that Ackman and PSH do. So that's where I would be looking at the moment because I just feel like there's a lot of value in those opportunities. But no one knows where the stock market's going to go, not even me. I wish I did. I'd be a very rich man. So it's just general in nature. Do your own research, but that's what I like at the moment.
Thanks, Arnie. Some good rundowns on a couple of companies there for people, the tankers to have a look at. And the company BetMakers was the other one, BET. So have a bit of a peek at that. General in nature on that one in terms of, I guess, an overview, putting my financial advisor hat on, is depending if $1,000 is a small portion of your wealth or if it's, a lot of your wealth. So if it's a lot of your wealth, you might take more of a conservative approach and go with sort of an ETF index tracker. You might pick a segment of the market you like, or I guess Asia you could look at, or you could look at, specific countries in Asia. You could look at, a tech area. It really could be anything. So you can invest in areas that you like. With an ETF, you can sort of search those and see what's going to suit your fancy. You could do a bit of a mix in a few different things. You could do some shares. You could do a real estate trust. You could do some in cryptocurrency as well. So diversifying that $1,000 to be able to help you minimize the downside risk a little bit too. So probably the area I wouldn't put it too much unless you've got some short-term plans is cash. Cash isn't giving you a whole heap at the moment. So, obviously you like to have a cash buffer and a cash bucket there for those emergency needs. But if it's money to invest, not too much in the cash area.
I love it, Jolie. Well, we've got a few Q&As this week. So one comes from one of the listeners, which says, is there news of big banks getting rid of credit cards and only having Afterpay? Is this true? So I had a bit of a look during the week at this, and I found an article. I think the listener might have got a bit confused, but the article says that PayPal is releasing their own version of a credit card in an attempt to take on Afterpay and the big banks. So it's a bit interesting in my mind that PayPal is going to be going old school and actually issuing plastic to people. But I guess it helps them as an interesting sort of, not a bank, but a deposit-taking institution in Australia. And they highlighted that they'll be awarding points to people that use their credit card, but it won't be limited to things like, flights, which haven't been really of much use in the last year. You'll be able to use the points at other retailers and stuff like that. So, interesting news there that PayPal are releasing a credit card to compete with Afterpay and the banks.
I'm sure that PayPal, being a tech company, plastic might not be their big thing. It might be a phone app that they've got the card there for your phone scanner to be able to double click and use. So
you think it'll be? Do you think it'll be digital wallet?
I reckon it could be. Yeah, I haven't researched it, but they might do a plastic version. But being a tech company, I'm sure they'd be preferring to use the digital wallet.
Yeah, you're probably spot on. And I feel like they're trying to branch out into all sorts of different areas so they compete with the banks. So now they're going to offer short-term credit, long-term credit, the normal PayPal platform, which has always been around. And I think they're getting into crypto as well. So,
well, I know the banks, PayPal, I believe they are. I know the banks have never, or generally the past decade, haven't been that concerned about other banks or other overseas institutions as competition. They've always been, the past decade, they've been more concerned about tech companies as competition, given the way that money's moving more digitally, less cash in hand, less need for floor space and physical footprint. Those tech companies are really sort of pushing innovation in that regard. So that's why the banks have really pushed their technology and their apps and the digital wallets and things for sure.
And the next question comes from our listener, Tanker Crystal Jolly, and it's basically equity release programs. What do they mean for older people? Great question. So thanks for writing in, Crystal. It's good to hear from our listeners. So the one I believe you're talking about is the pension loan scheme. So the government released this a couple of years ago, and they've been tinkering with it and making it better. And they just changed it again. So it's a pension loan scheme. So what it means, if you're on age pension and you own your principal place of residence, you've got the ability to be able to use equity in your home without necessarily selling it. So what that means, if you own a home, let's say round figure, $1 million home, which is quite common nowadays in Melbourne especially, you can actually give some of that equity to the government, Australian Government Services Australia, so Centrelink. You can choose the amount that you'd like to have as a loan, and they'll pay you an amount on top of your age pension every fortnight, only up to 150% of the maximum rate. So as an example, if you're a single on 962, I think is single age pension max, you can only go up to about $1,400. So you can't exceed that, and you can't take a lump sum either. It's just paid to you to provide some extra liquidity, which could be quite advantageous for people that fall short during retirement and they've got this asset in the home but not a lot of other liquid money. They charge an annual interest rate at 4.5%, so it compounds each fortnight. So 4.5 to the market is still a bit high. I believe it was higher, so I think they brought that down. Hopefully there's more to come of that coming down a bit more, because 4.5 is probably still a little bit toppy. I guess is an example of how it works. So if Susie gets a loan under the loan scheme and she decides $195,000 of equity or security she wants to give of her home, she chooses to get a loan of $750 a fortnight. After 10 years of giving that loan to Centrelink, the loan balance goes from $195 to $246. So that includes a compound interest over that period of time of 10 years, about $51,000. That's just an example on the Australian Services Government website as how that loan works. She gets the income from that over that period of time to help her provide more liquidity on top of her age pension, if she is getting an age pension, because you can actually do this if you don't get age pension or you only have a small part age pension, you can actually draw it as well. So, so that's just some examples of how the pensioner loan scheme works, which is a bit different to like an equity unlock and a reverse mortgage, which can be seen a little bit riskier. So I think this is probably going to be a good way to go for people in the future that may fall into this category. And presumably, Jolie, the balance of the debt will go to the estate if it's not repaid before then.
Yeah, so you can repay it before then, or it can come out of the sale of a property. So once the security gets sold, the loan will be paid back or through the estate. Correct.
Okay, thanks, mate. Oh, well, that's some good. Thanks for the listener submitted questions there, Tankers. And
great question.
On to our favourite segment, which is 50-50, what's your choice, this or that. Gun to your head, what do you reckon?
Love it, mate. Love it. I love all the names. And have we got any more names? Was there one other name as well we had?
I think I'm forgetting one. 50-50, this or that, what's your choice?
Just to add to the mayhem.
Either or.
Either or. So, so we had a listener question in this week from George, a friend of ours and friend of the pod, avid listener of the podcast, George, and friend of our producer, Matty. So George texted me and said, hey, Joel, I'm sorry it's taken the weekend because we spoke about it on the Friday and he must have been dwelling over it on the weekend. He goes, I can't believe this took me a whole weekend to think of. But he inevitably came with a 50-50 of what do you prefer, still or sparkling water? Ooh. So let's talk, when we talk still sparkling, let's talk a glass of cold bottled still water, so spring water, or a sparkling version of that water. What do you prefer?
I got to go with still because it's just, the substance of life. But I know we're not meant to do caveats here, but
substance of life.
It's the nectar. But a bit of a caveat here, Jolie. I haven't had an alcoholic beverage in like 18 months or so. And I find myself nowadays when I'm out and about with people or in a social situation, I drink way more sparkling water than I used to because I don't want to just keep drinking Coca-Cola, and you want something a bit more special than just flat water. So I do have a soft spot for sparkling nowadays. But if I have to choose, I'm going still water.
Yeah, okay. It's a hard one to choose, man. I'm with you actually on that because I usually fill up the drink bottle with cold water during the day and just have that nice and chilled. Love the cold water, which is still, and if I'm exercising, obviously as well. But yeah, I don't mind a bit of a sparkle to spice up life a little bit. Come dinner time, you open up the sparkling bottle, or you got the old what do they call it? The pump one, the I can't remember the name of it now.
Yeah, like the soda bomb one or whatever.
Soda Stream, Soda Stream. Not promoting unless SodaStream wants to throw us some bank. You get the SodaStream bottles and fill them up and give them a bit of a hit. So, and you know what I've noticed recently with a few cafes I've been to, one in town I went to the other day, bring the coffee out, little glass of sparkling water with it. Ooh, yes. Great addition.
Classy.
Great addition. Just helps cleanse the palate a little bit.
I love that. Oh, yes.
So if you're a cafe owner listening out there, add that to your repertoire, and I guarantee you'll get me coming.
What did George say? What his preference was?
He didn't even bloody tell me. I don't think. He didn't tell me. So we'll have to get Georgie. Yeah, we'll have to get him.
Awesome. Well, that's it for another week. Do you want to give a bit of a tease about what we got going? We got a good episode coming next week for the Tankers, Jolly. What's happening?
Yeah, mate. So I'm just messaging George now, actually. So if he gets back to me in time, I'll announce it on the pod. But next week I've spoken to a friend of the pod and a friend of ours, Dave, who runs as a franchisee the Sporting Globe. So we're going to get Dave on hopefully next week and organise a catch up on Zoom to talk all things Sporting Globe, I guess, and just the life of a franchisee and how it works, how he runs the business, some of the things that work really well and some of the things that he's found don't work as well. And just generally, some interesting topics, I think, around that sports bar market and, how they operate things. So I think that'll be exciting for listeners to tune in for. So keep an eye out for that one next week.
I'm super excited about it. I feel like that's an awesome topic. Yeah, so thanks for joining us, Tankers. If you want to get us, just reiterating, it's at Money in the Tank, YouTube, Twitter, Facebook, Instagram. And if you drop a like, comment, or subscription on the YouTube video, that'll help Jolie and I grow the channel.
And George got back to us sparkling every day of the week when it's there, that is, in brackets. So, and he said, how about you? But I'll say, he's going to have to tune in to listen to our answers.
Nice one. All right, cheers, mate.
Listeners, you take care, guys. Go D's tonight, mate.
Yes, go the D's. We'll touch on that next week as well. See you, mate.
See you, crew. Bye.